This question is looking at uncertain cash flows. There might be situations where we are looking at a capital budgeting project and we have a good sense regarding most of the elements of the analysis, but there might be something that we're just not sure about. It could be a situation like this where we're not really sure how to measure the intangible benefits. We're not sure how to assign dollars to those. Or it could be a situation where we don't know what the salvage value of an item is going to be, or maybe just what the revenue generated by the item or the contribution margin generated by the item. So we're basically filling in the gaps, filling in a missing puzzle piece. Right now, this company has performed its net present value analysis, and when you see a negative net present value, the answer is usually no, we should not make this investment because that means that our return would be less than the discount rate, and this would not be an attractive project for us. However, it's important to look at financial and non-financial considerations. So even though the financial net present value is a negative $173,000, we might want to have some discussions internally at our company to talk about, well, what are the intangible benefits for this particular project? So what we can do is we can take that negative net present value that we need to offset, because in order for the answer to be yes about this project, we need to have a net present value of 0. So the net present value of the intangible benefits would have to be $173,055 to offset the negative NPV elsewhere. Now what we want to do, these are annual intangible benefits. Anytime you're dealing with an annual amount, you want to look at the present value of an annuity. And we're dealing with a 17% rate, so let's circle that right here, and a useful life of 9 years. What we want to do is go across, find the intersection right here. So the present value factor for an annuity, when the discount rate is 17%, the useful life is 9 years, is 4.451. So let's divide the required present value by 4.451, and what we will get is $38,880 per year. Okay, we can double check that too. I mean, all you have to do is, if you knew that the intangible benefits were $38,880, and multiply that times 4.451, you would obtain a present value of $173,055, which is exactly what we were trying to offset. So what we're basically saying here is that we might still consider this project as a valid investment if we thought that the intangible benefits provided us with a value that was somewhere in the ballpark of $35,000, $38,000, $40,000 per year. It's really difficult to put an exact dollar amount on them, but we can start to have those discussions internally to see if that makes sense. Now, let me just flip this around a second. The question doesn't ask this, but let's expand the question. What if instead of the intangible benefits being the unknown, what if we're not sure about the salvage value of this equipment at the end of 9 years? It's a very similar calculation, but you need to use the present value table for the present value of a single sum in that case. So what we would do, we would not use the annuity table. We would use the present value of a single dollar. The discount rate is still 17%. The number of periods is still 9 because that's the 9th period. We would presumably sell this asset at the end of the 9th year. Let's double check. There's our present value figure, 0.243. And now we simply divide. And we get 712, 160. Let me write that again. I don't think I did a very good job writing that. 712,160. So what this is basically saying is that if we could sell this equipment for $712,000 at the end of the 9th year, then this project might be an acceptable alternative as well. So the uncertain dollar amounts could either be annual amounts, in which case you need to use the annuity tables to figure that out, or it could be a single cash flow at some point in the future, in which case you need to use the present value tables for a single sum.